Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance, and it is the last public stream of the year. It is December 30th. I'm having a great day. Tons of trades in the trading room today. I hope you guys are having a good year. We're doing our year-end wrap-up, and I'm always like super busy. Over the holidays, I've been working very, very hard on refining my options journal. My options journal was a sheet that I released about 3 years ago, and it's really designed for like single leg options or for doing like tracking of like leaps, poor man's covered puts, kind of that type of thing where you have potentially like a long option that you're going to buy, a year out, and then you're going to sell a whole bunch of short duration options against it. And that sheet it works quite well, but I never really did like a kind of a robust summary sheet on it, and so I've been working on that over the holidays, and it's really cool. It's got I've added a bunch of great features to it. I was really trying to get it out for the new year, and unfortunately I feel like I'm going to miss that deadline because I don't like to release updates unless things are really perfect, because it takes a long time to get all the coding right, and when I'm working on these types of things, there's a lot of mental capacity that goes into it on top of the hours that goes into it. Like Christmas morning, the kids were up, the house was full, and I was here plugging away, working on programming that out and trying to get that done. Here, Atticus is coming in the room. He is feisty today, so I'm sure he's going to be up on the desk to say hello. Let me know where you're watching from, and if somebody could let me know that the stream is working and that my mic is working, that's always good to know. We're going to get into what's going on in the market, and remember, anything I talk about here is not financial advice. It's just what I'm looking at, what I'm doing, looking at the new year. So let's get into it. I've got a bunch of things open right now. We're gonna take a look over at Trading View. This is the SPX. We're looking at the daily chart on this, and you can see what's happened. We've got VWAP way down here, 62.80. Currently trading at 69.04. This has been an absolute incredible year. The market is up a ton. If we look back over the course of the last year, obviously in the spring, last December, we were sitting here at this, and we were sitting at the top of the range. And as we came into the new year, there was a bunch of activity that caused the market to go down, and we got down to the bottom of our Bollinger Bands. We saw under the VWAP. There was opportunity here. I know myself and a ton of people in my group, we very much took advantage of this down move here and entering trades in April and May, and have definitely been rewarded for that. And when we're watching this, we have to be fearful we have to be greedy when others are fearful. You know that saying from Warren Buffett. So on one of the things I'm looking at on this chart is these long entries that appear on the Bollinger Bands. We see that kind of thing happening. We saw all of these trades be winners so far this year. And interestingly enough, we didn't get a signal on SPX. We're touching the band. We touched it 3 days ago. We didn't get a signal to exit, which is a bit unusual, I think. I would have thought that this would have triggered. So we'll see what happens, whether or not we'll get a long signal. But in any case, what I'm looking at are these ranges where I'm saying although there's a lot of activity up here and there's been a lot of trading, the VWAP is still down here. So this is when I tend to not worry so much about making upside returns. When we're getting into this kind of flat consolidation side, are we going to push down in the new year? Is there going to be some selling pressure? Well, there easily could be. So it's something that I'm looking for, and I'm adjusting my positions accordingly. Let's look at NQ on that same thing. We've got earlier this year, I drew this line on here showing these higher lows that were occurring. So this blue line, why do I make everything blue? I should just change that. How do I even change this on here? I should go to settings and change this style to, let's change it to something else. Let's change it to like pink. There, is that a little bit better? The pink line here that we drew on the NASDAQ has been interesting. We blew through it. It didn't act as a resistance on the way up. We came back down, very much staying within this kind of tighter range. And now it looks like that line may have created a little bit of resistance at the top. You know, I don't think that that line that I drew has much validity really at all. You know, it was working, but really what was happening was it's intersecting off of VWAP and off of the Bollinger Band each of these times it bounced. And we can see that happening. Have we bounced off the top is the question. And you see what happens when we do. We often see a downtick in the market move. I am setting up for a slight move to the downside, and you know, I don't like to be pessimistic like that, but I just have this feeling that we're going to see a little bit of selling in the new year. Russell, same sort of thing. We're at the top of the range. We had a buy signal recently. It hasn't hit the top of that Bollinger Band. We were definitely close to it, but we never got that signal to exit. VIX. This is, look at this. There's a long signal on the VIX. That doesn't happen very often. The VIX trading out 14, so that's way below. There's a lot of complacency in the market. This is typically when we see some sideways motion. This is not the time for putting on trades like iron condors. Terry's watching from Claire's home, wishing a happy new year, very prosperous new year. Me as well. Terry, thanks for joining as always. Thanks for being a longtime supporter, and I hope your next year, your 2026, is fruitful as well. I think it's, you know, we're always hoping for that as traders, is that we can maintain, you know, a steady increase in our account valuations as we go on. Oil, I never did take a trade. There's something about this particular cycle. I just don't want to get into it for some reason. Gold, we've been pushing up and up and up. You know, the metals have done extremely well. Silver and gold both had a large candle down 2 days ago. There was, you know, a little bit of squeezing going on some of the futures contracts that were expiring, and we'll see what happens with both of those. But you know, it's really hard to say. Apple. So recently I put on a position. This is where I like to, you know, kind of play with my option stuff. So I put on a position that had no downside risk. I had about the 280. My profit range on the position is basically like this. It's like, it doesn't matter how much the stock drops. I don't lose any money. I'm hoping that it kind of stays where it is and I make a little bit of money on theta decay. But that's the kind of nice thing that we can do as options traders. We can effectively short the market without actually shorting the shares. In this case, I'm actually long the shares and I don't have any downside risk at all. Even if Apple was to go down to, you know, $200, I would still make money, or I would not lose money, I should say, on that particular trade. AMD, let's look at this. Micron is the one I want to look at. We're seeing all-time highs repeatedly happening over the last couple of days. And if you guys have any particular stocks you want to take a look at, let's take a look at them together. Just type them in the chat. AMD did get a long signal way up here. We're currently trading below that. But that long signal seemed a little bit weird. You know, sometimes this is based on the Bollingers. We can see this movement, but I think it triggered a little bit too early. It triggered here on this particular day, but I don't love buying stocks. If you guys go back and watch some of my old videos, you know, I'm always looking at VWAP. This is where I want to be buying my positions. So when I'm putting on positions, where am I buying? I'm trying to buy above VWAP. ARK-K had a long position, a long Bollinger Band trigger here. Well, when we got down closer to the VWAP, this is a much better time to be buying. So, you know, we're looking at this. Point of control is down here at $75. ARK-K is trading at 78. These are the type of trades that I would be looking for, taking some downside. And Adobe, we saw this long signal occur here, and that was exited and profited here. I don't actually work off these triggers. It's just something that I have on my Bollinger Bands. These are automatically generated here in TradingView for me to look at. And it's good. It's good to see them. Like Amazon, we saw this move here. That was nice. You know, like, had you taken that? These are often correct, these signals, more often than not. So it's definitely something to add to your strategy. That is the Bollinger Bands. It's an RSI Bollinger strategy. You know, there's a bunch out there, but you can kind of see what they are. There's Bollinger Band strategy here. I built one myself based just with ChatGPT, but if we turn that on and off, you'll see what that's doing. It's creating this kind of wave of Bollinger Bands, and it's giving these long and short entry, which has been pretty great. So Amazon point of controls at 222. When I'm looking at a stock like this, it's trading at 231. How do I assess it? Well, one of the things I have lots of tools that I use. So I'll go to a company like Investing Pro, and this is the paid version. I have links down below if you guys are interested in signing up for yourself. If you're trying to take your trading to the next level, and you're saying, well, where might I want to buy a stock? Well, in this case, this gives me a little bit of data to look at. Amazon's currently trading at 231. It's trading at a low price to earnings ratio relative to near-term earnings growth, but it's trading at a high earnings multiple. So there's a bearish and a bullish sentiment here. It's a prominent player in the broadline retail industry. You guys must know that. I mean, Amazon's been around forever. And then cash flows can significantly cover interest payments. So they have no problem with cash flow, which is great. You know, these are the types of things I want to look for in a company. One of the key metrics that I look for on investing.com is fair value. You know, is this, here's the market range over the past 52 weeks. We traded down as low as 161, as high as 259. Fair value is showing at 254. So it's actually 9% above where we are right now. And so when I'm looking at this, how might I set up a trade? Well, the stock's trading at 231. This could be a potentially really great time to buy. That's one component of what I'm looking at. Other things I'm looking at are, let's get off of that. Sorry, that's the wrong chart. I'm looking at it in terms of where it is relative to VWAP. And this one is 216 down here. So if I was to mark some of these levels on here, 254 fair value is considerably higher. That investing.com is quite bullish on Amazon in general. We're seeing quite a lot of trading in this kind of center range here. Let's see if there's a trade that we can take. Now, this isn't particularly a great setup because we're above the point of control, which is nice, but we're having a slight green day, and we're above even the recent in the Bollinger Bands. But let's take a look anyways. Like, what can we build out in a low VIX environment? So I'm using Moomoo today. We're gonna take a look at Amazon. And again, I have an affiliate link. If you guys are interested in checking out any of the stuff that I use my links down below. It makes sure that you get the best deal in signing up for any of these platforms when you use affiliate links that are recommended by YouTubers, and they give me a kickback. So it's a win-win for everybody. We're all, you know, we're using products. Like, I don't use any products. I don't show any products that I don't use on a regular basis. So know that I'm not just promoting random things. You know, when I'm looking at something, it's because I actually think that there's some validity in what could be out there. And so in this case, looking at Amazon, looking at the table, January 30th, which is 31 days to expiration, is there some value? Well, there's quite a bit of premium. If we look at from a delta perspective, if we scroll over here, the 16 delta, this line right here, I'm just gonna highlight that. That's the 215. It's collecting $1.43 for the 16 delta position. Now, if I was selling naked puts for a 30-day time frame, this actually isn't enough money. And this is where we get into a low VIX issue. When the VIX is low, as it is now, when we're below 17, the premium that we're collecting for selling a naked put is not worth the risk, in my opinion. Can't even make 1% off this. I'm taking the risk saying I would buy the shares at 215, stocks trading at 231. There's a 16% chance that I could get a sign. There's an 84% chance that this is going to expire out of the money. If we look at the curve, we're going to see, oh, it's asking me to add an option. I got to sell that. So let me click on that. Let's go to the curve. You can see what would happen. It's a flat line. The profit profile is key to understanding what we're doing. Basically, I would collect $147, and I would get to keep that $147 as long as Amazon stayed above 213. Again, I'm going to go back to another tool. We're going to go back to TradingView, and I'm going to look at where that 215 level is. Well, that 215 level is below this Bollinger. The last time we got that low, there was a long signal, which was quite profitable. There was an earnings report that came, and that will cause that profitability, but where that would not be such a bad range to be in. Now, the other range that I wouldn't mind is looking at like the 220. Is that something that I might consider going long Amazon? It would be below this inside Bollinger Band. if we look right there. So what am I looking at? I am looking, let me just draw this exactly. So I'm looking at this point and this point, and then I'm saying, where does 220 line up in relation to those? And you can see it's just slightly below that lower arrow. And that is potentially an area where I might want to enter a trade. So I can do this in two ways. I can do the naked put, which has a lot of risk to it. It's a $21,000 risk. And this is to make a max profit of only $147. Not particularly great. The theta decay is all right. It's positive. It's at $6 a day. Does that work out to 145? No, it doesn't. If you look at how this is the 30 days to expiration, the max we can lose from a theta decay perspective is only $3 per day on this trade. If I was to collect 150 bucks, divide that by $30, it would be $3 a day profit on this trade, tying up $21,000 in capital. So that theta is overstated by quite a bit, and this is typical. So it's something to be considerate of when you're building out, like how much money do you want to actually make in your portfolio relative to how much we're risking. This theta decay is currently double the maximum that we could achieve on this particular trade. Now, what could we do to this? Well, the simple thing would be to buy a lower position. You know, just simply spending some of the money would define the risk of this trade. We've still got an 85% probability of profit because we're selling the 16 delta. Well, I just filled on a nice little trade, a bearish trade on ARCAT. So I'll have to post that in my chat room when we're out of this. But you guys probably heard that order filled. That was nice. What was that return? It was like 300% return on that little options trade. Looking for downside moves on some of these stocks that are not particularly great. So that's a nice little bonus for me while we're doing this stream. What I'm doing here, this is what's called a bullish put spread, and you can see by adding this long put, what I'm doing is I'm significantly reducing my overall risk. Max loss is $3,869. So it's about like 1/8. The theta is still $5. This is what I would consider a wide spread. I am the maximum profit is 131. So because I'm only paying $23 for the protection, effectively what I'm doing is I'm turning this into what we would consider a synthetic naked put. When we look at this curve, you can kind of see that. You can see that if the market goes down, I still lose a substantial amount of money. If the market was to drop to 176 or Amazon was to drop to 176, I would be down, $3,800. And that is substantial. But my max profit is still high. So that is one way to trade this. This is basically this $23 spent is the equivalent of a black swan hedge. We're putting that money out there and saying we're cutting into our profits, but in an event of catastrophic failure, I cannot lose. This is one way to reduce risk overall. The other thing we can do is change the dates on these. If I wanted to sell that 215, I can actually buy further out in time, and it has even less decay. You'll see that this actually has even a lighter expiration P&L. The theta decay is, in this case, is actually slightly more, but we add some upside risk to doing this. If the stock was to rally up above 281, we would be in a losing trade. So I have the potential of making similar money, and in low volatility, these trades can work extremely well. How much am I paying for that 175 out in April? Let's go take a look. It doesn't actually show me here on Moomoo, but let's look at April. How much would it be costing me? I'd be paying $147. So this trade, the idea would be that once the short put expires, I would be able to sell off the longer dated put. And since there's only 31 days and there's 107 days left on the April 17th, there would be 70 days left. Ideally, the stock would drop in this case. If that happened, this equity curve, the IV would increase and this equity curve would actually get bigger. So important that the setup works. These aren't equidistant all the time, so you have to be aware of kind of the parameters. My max loss is actually slightly more in this case. I've actually increased the max loss and I've added upside risk. So diagonals can work for us and against us. Now, what happens if nothing changes? This trade makes about $65 comparatively to if we did this on the all on the January. This trade would make $130. So there is more potential to the downside. There's less kind of overall risk with that diagonal. There's a chance of IV expansion, but it comes with a reduced amount of profit over the next 30 days if the stock doesn't move in that downward motion. You know, another thing that we could do with these is that we could actually combine these two together. I'm going to move this one in though. I'm going to move this long put, and you'll see why I like to use Moo here. And as I'm doing that, you'll see the T0 line is increasing or changing in the slope. And Trader Bob's asking about, hi Trader Bob, good to see you. I ask him about YBTC. I am still adding to my YBTC position, so let's take a look at it. But it has been fruitful so far. This slope, as we pull this in, the max loss gets smaller. The max profit gets reduced because I'm paying more for the long position. The pop doesn't really change all that much. You know, I can basically slide this right over, and you'll see that this probability of profit hasn't changed. What is happening is I am increasing the amount of money that I make. I got a lot of arrows on there. Increasing the amount of money I can make relative to the risk. So in this case, max loss is only $452. The theta though is really, really low because the total amount of money that I'm going to make is only 48 bucks. So there's a couple ways to do this. If I wanted to make more money, what I would do is I would increase the number of contracts that I would have here. You know, I would do, 5 contracts would give me a max loss of 2260, max profit of 240, 84% probability of profit. Or another way to do it is to look and say, okay, here's my risk. What if I slide my short shares closer? And what if I make a little bit more of an aggressive trade? Now we talked about the 220 line. So let's just scroll this up or slide that up to the 220. This increases the max loss considerably because of the number of contracts that I have on. So all of a sudden I jumped to $4,300 in total risk. Comparatively, I'm just going to slide it back down to 2260. So this is doubling it based on 5 contracts. And again, what is the better trade in here? Maybe it's better to take a higher probability trade that's a little further out and have more risk and have a little bit more slope on it. Or sometimes like this one actually has less trades. Now that I've done 2 contracts, I still can do max profit of 262. My probability is a little bit lower. Typically IV is overstated. So when we look at this probability of profit, IV is overstated. Now I'm going to show you a quick little way that you can kind of protect a trade like this. Let's say I'm doing 2 contracts and I'm worried that the stock is going to drop down into that range. And I'm looking at TradingView and saying, you know what, there's a really good chance that we could drop down into that between 220 and 210. And in that case, this would be the worst case scenario for a type of spread like this, because if it dropped down to 210, right at 210, we would be at the max loss at expiration. So this would not be very good for this trade. So what can we do? Well, let's take a look at buying a cheap calendar. So we'll go to the table view and we're going to go one date pass. So this is going to be February, and I can sell the 210 put for $2.54. So I'm going to get $250 deposited into my account. And now if I go further out, if I go to like March, how much does the 210 cost? Well, this cost me about $500. So I'm going to collect $250 for selling the 210 at the end of February, which is a week past the expiration of this this spread, and I'm going to buy the 210. Now I'm going to just do a single contract with these. So this is a calendar spread. I am purchasing a calendar spread. I'm buying it, and what does that do to my profit loss chart? You can see it's interesting. It kind of slopes it. Expiration P&L now is $314. I've added some upside risk for sure. You know, if the market goes up, I won't make as much money. But I'm not worried about that right now. What I'm looking at is like what is my risk to reward? Does this make sense to put this trade on? Well, the expiration P&L on this trade is like $509. I still have this risk. If it goes to 210, there's still some risk on here. But if there's a bit of IV expansion, which could occur if this happened, let's just see what happens with this. Does this increase? It doesn't. It doesn't go as far as I would like. And what I can do with that is I can say, well, what if I was to buy 2 of these? What if I was to do them equal to what does this profit tent look like? Well, now look at where my break even is. I'm going to reset the IV, assuming the IV stays the same. The break even's around 215. It's a pretty good trade. These are pretty good trade setups, but I've added some upside risk. If Amazon rallied from its current price of 230 up to 246, I would actually lose money on this trade. So I have to be careful. My max loss is about $2,300, but my max profit is 700. Probability of profit still in a nice range, 60% here. So there's always a sweet spot for everything. What if I did 3 of these, 3 to 2? You know, sometimes you see that like ratio and you're like, wow, man, that really works out. Probability of profit 73%, break even on the top side 260, so virtually no upside risk. Break even on the downside with no IV expansion 216. If there's a bit of IV expansion, could drop down around 213 before we get into max loss mode. So depending on what your assumption is going into the new year, these might be trades that you might want to consider. Learning to kind of match things up and say where can I make some money. We can do these a little bit tighter too. We could do like the 215. Maybe that's a better place to do this. You know, we can adjust them. Once we get into some more complexity of these trades, there's a lot going on. What I'm looking for overall is high theta decay, defined max loss, max profit. You know, these are peaks, so this is a little less important to me. I mean, I would love to make 1/3, like 30% return on my max loss every month. But that's unrealistic in this case. I don't expect to make 953. If I was to make, you know, $400 on this trade, that would be an extremely good return. I would be more than happy taking a 15% return on a position like this that I know can handle some IV expansion. So something to consider moving forward when you've got your positions on. And of course I tweak these. I often tweak these even a little bit more than during my live streams. And those get posted in Patreon. So if you're interested in joining the Discord chat, becoming a member of the Drawbridge Traders Club, you can head over to patreon.com/Drawbridge Finance, and you can join the Options Trader Club or the Drawbridge Traders Club. And there is opportunity there because we're posting trades. I'm posting trades every single day. I try to average 10 trades a week, but new trades a week, but I typically have about 100 trades on. So there's so much. Like there is way more than a sane person would want to put on. Lots and lots going on in there all the time. Okay, let's look at YBTC. Now I'm just gonna go over to and just look at what Investing Pro says about Roundhead. It doesn't actually say anything, does it? It's just this is a covered call strategy ETF. It shows what the market cap is, $222 million. The dividend yield right now 64%. So last year, I started buying some of these. The stock ran up quite nicely. It was positive for a while. It's really about the dividend, though, on these. Let's take a look at Moomoo and see what it says about YBTC. And if we take a look at what is going on with the dividends, if we were to look back over the last year, this chart is so dramatic. I love it. We had a high of $58 in December of 2024. Then the dividends were a little bit less sporadic. This was a relatively new product, right? It's only been around since January of last year. So we're coming up on its second year. If you had purchased at the beginning, you would have paid $48 a share. But the dividend payouts have been massive. Like this dividend payout was $4. So this dividend was $1.80. So you got $6 in dividends right there. The first 3 dividends were the equivalent of almost $10. stock is trading right now at $29.95. So somebody that had held just here, those first three, and number four, you basically had like $11 back in your first couple of months. Now the dividend is much lower, but it's also weekly. So we get paid 38 cents, 39 cents, 41 cents, 39 cents, 37 cents. One of the things that I like about Moomoo is it shows this little chart right here. I'm going to turn myself off here on the right. So this is an interesting thing. It actually shows the trade net inflow to outflow. And it's one of the things that I look at with these types of products. Like, are there more people buying than selling? And in this case, you can see there's much more buying. We have some large trades happening. We've got some medium-sized trades and some small trades, but the money flow daily has been increasing. Let's look at this day, December 10th. So December 10th, which was right here, we actually saw a large inflow of money, quite a large block. 10 million shares traded that day into the position. So I like when I look at a covered call ETF and I see that the inflow is positive and we're seeing consistency in the dividend. The other thing I like about this is that if we look at the dividends, we've got some upcoming dividends here. We've got cash dividend of 89 cents, which was just paid. The pay date is December 26th, and then we have the ex-dividend date of December 17th. We saw 21 cents, but pretty consistent dividend return and decent amount of inflow. So that's kind of the things I'm looking for in these types of stocks. If you look at some of these other stocks, like let's just pull up the chart on this. This is MSTW. This is a weekly pair on MicroStrategy. And this one's still not so bad. The net inflow is slightly higher than the outflow. And we can see that here. We see more in than out. Some of these products, like if you look at the Yield Max products, they have not great. There's a more outflow than inflow. So if you look at this TSLY, which I also hold, there's actually quite a bit of outflow happening. Is it even? Yes, slightly even, but not all of them are like that. If we let's look at YMAX, like tons of outflow out of this. And this is one of the problems with these covered call ETFs is that if the stock is depreciated, then people start dumping their positions, and you can see it's just dumping, getting out of here. And the outflow in this case, there's twice as much selling happening than buying. And I don't think that these are great positions to be buying into. Roundhill weekly pay, here's one that just more outflow than anything. So until this reverses, it may not be a good time to be buying. WDT, OP, here's another one that has more out than in, and that really is causing these prices to go down. Do I have any? Let's look at that's Harvest. That's the Yield Max products have been just getting beaten up online. If anybody follows in Reddit or anything like that, you'll see that most of these Yield Max products have a positive or have a negative outflow, which is not great overall. Amazon is a pretty strong company. It really depends on the underlying, but especially some of these like Coinbase. Here's the Harvest one. Tons of selling happening. Yield Max, Coinbase, lots of selling. Hood, net positive inflow, kind of small, but net positive today. So, and again, looking at the chart, is this a good time to buy some of these? The dividends are huge. I mean, when you look at what it is, you're paying $48 for this stock, and it's paying 72 cents weekly. So $1.30. The yields are crazy when you look at what it is. Does it show it here? Does it show the percentage? I can't see it here on the screen, but does that kind of make sense as to how? So I think Moomoo has some great tools in that respect for looking at some of that stuff that it's harder to see on other platforms. And you can see I have a whole bunch of different positions, like this call ETF, tons of outflow here. you know, all of a sudden, like what's going on? That's just today. Overall, the inflow has been good if we look back day over day. But today, lots of selling. So is there profit taking happening today? Potentially. You know, when did the dividend pay? This is a Canadian one, 12-cent dividend. Some of these Canadian setups are quite good. So depending on what you're looking at, I know this is another popular one, HDIV. And again, net inflow today is positive, and over the last little while, it looks like it's been net positive. So if we look at the weekly chart, we see more buying than selling. But we did see some selling in February. So we saw some buying in January, some selling in February, and some selling in March. So interesting to see that. And when we overlay that with the chart, like what happens when we see selling, then the stock price goes down, right? February and March, there was some selling. Did somebody know something? I don't know what happened here. March, you know, this is, yeah. Interesting little thing. Okay, what else do you guys have? What other stocks do you want to take a look at? I like to keep this snappy. Trader Bob, very interesting. I'm still in IBKR, but really like that Moo view. Thanks for that. You're very welcome. I think that this is a combination thing. There's trades that I'm doing in Moo. There's trades that I'm doing in IBKR. I don't think that, like, if I was to do a comparison video of the two and say, like, is this one a winner and this one isn't? Moo is super snappy. It's like, remember, you guys have been watching me for years. Remember when I show IBKR and it would just be like lagging the options chain, and like the profiles are not that great. I can't slide things around. I think building out the trades in Moo are quite good. From a portfolio sorting positions, the Moo is not as easy as IBKR. I like the way that IBKR allows me to kind of sort by expiration. I mean, most of the stuff is handled in my Rourke anyways, in the rolling options record keeper. The reason for that is because it keeps me sane. If those trades break apart, I know exactly what's going on, because I can track the components of everything that happened as I made adjustments to the trades. And I tend to be in some of these trades a little bit longer than some people might, because I like to play a longer duration trade. That being said, and what do you guys think? Do you think that the markets are, does it allow SPX option trades on Moo? Absolutely. You can do SPX option trades on Moo. I don't know about the commodities. Yeah, so I should be able to. Can we do like GC? I haven't actually traded these. I think that, from talking to Moo quite a bit about where they're trying to expand. I mean, they are aggressive and they're around the world, and they are kind of a skin on top of a brokerage, right? So it's a Chinese company, but what they're doing is they're offering basically this trading platform that you can use, and they used to be based in Canada. They used to actually be based on top of IBKR. So the account that you opened was an IBKR account, and then the Moo skin was effectively trading on top of that. So allowing us to use the interface, but the trades were being executed in IBKR. Now it's in Canada, it's I want to say it's Canaccord Genuity, but I'm not 100% certain on that. But the base trading is happening there. One of the things that they're doing is they're expanding rapidly, but what they're trying to break into is more of the options game. That's one of the things they want to show. They want to show more options to people, and they're being aggressive with their pricing. So when they first reached out to me, they could only do two-legged trades, and I said to them, like, that for me, that doesn't work at all. Like, I'm a complex trader. At Iron Condor, at minimum, to me, I think an Iron Condor is a basic trade. I don't think we're adding any complexity there. It's like you're doing a put spread and a call spread. Like, it's pretty basic. It's in and out. It's a defined risk trade. Not a lot of adjustments to do to it. People often ask me that. It's like, I get enough credit to open those trades. I let them run, and if they stay in range, I can continue to hold them. And if they break out of the range, I close them for a loss. It's one of those things. That's how I trade an Iron Condor. Moo didn't even have that capability when they reached out to me like a year and a bit ago. It's been a while, almost 2 years ago when they first reached out. And I said, hey, when your platform gets a little more complicated, then reach out. And they did. Not only did they get back to me and said, hey, we now have four-legged trades, which I think is a minimum, but they are also super aggressive on their pricing. Contracts are only 65 cents in Canada. That's cheaper than IBKR, unless you're doing super high volume. So it for me, it seemed like a no-brainer. It's like I've got tools at my disposal that are cutting edge. They are expanding, and it's been a great addition. Is it a replacement? I think at this point in time, I'm still using both. And so I have to kind of look at different types of things. From a perspective of commodities, like I'm not seeing, I'm not seeing gold pop up here. So maybe I don't know how to enter it. No, I just am not seeing it at all. So there's futures. I mean, there's warrants. Gold futures, yeah, okay. So yeah, it looks like we've got gold futures on here. Let's look at oil. Yeah, so here we go. We've got the main, we've got January 7th. So let's see if we could do something here. What could we do? This is a February contracts. Every brokerage is slightly different, right? So here's the pricing that we were looking at on CL. I'm just going to turn myself off here. We can see where actually it doesn't matter there, does it? You can still see me. Prices here on the left. So we've got $58. Can we trade options on here? Yeah, it looks like it. So similarly, we can go out. We can say, 30-day, January 29th, what might I want to do? Or, if I wanted to sell like a spread here. Both, all strikes, chains. I don't know why I'm not able to select here. You're seeing me fumble around here because I am unable to select those contracts. But it looks like they do have futures available. So just different ways. CFDs, again, I don't know whether or not they have them. I'm trading just plain options on stocks, and some of the stuff I like are like if I look at the markets and I want to take a look at so they've got crude oil. Can we just play right here? Like if we wanted gold, can we actually play this? GC main, yeah, like that's how easy to get to it. And again, I love the interface. Is this actually functioning? I can't seem to figure out how I would actually put a trade in there. But yeah, one of the ways that I'm looking at this is, I'm looking for stocks in particular. So I might be looking for, some stocks that are moving. And in the markets tab here on the app, like the phone app is so great. It's actually better than the app here on the computer, because when I click on things, I can go and see the cash secured puts, and it'll pull up a list for me. It's pretty fantastic. Where's my phone? Maybe I'll just show you that. Like if I showed you how that functions, then the app is super slick. So let me just clear this off. I kind of have it open all the time, but if we were to go through and I was click on the markets tab here, so I'll just show you what's going on. Let me see if I can get that to focus. So this tab, the market tab, and what it does is it has like crypto ETFs. It shows unusual activity, 0 DTE trades, cash secured puts. Like this is killer. This list of cash secured puts, dangerous to play some of these. But look at these annualized returns. You got, Fly, the 23 put. You're collecting $75 premium. It expires in 3 days. So what I might do with this information, now that I have that, I would just go to the main Moomoo app and on my computer, and I would type in Fly. So I can use these kind of, and I can be logged in on both devices at the same time, which is awesome. So I don't know if you guys know Fly, it's a aerospace company, but if I go to the options tab and I notice that that is showing this massive amount of potential here. So if I look at the curve, stock's trading at $23. Well, selling the 23 put gives me a break even of $22, gives me $75 of profit. It's a 64% probability of profit against a $2,200 position. Well, this is like a 3% return in 3 days. That's 1% a day. Now, this stock could go way down. So you kind of have to pay attention to what's going on. You know, like if the stock went to $20, which it was a week ago, are you going to be crying in your soup? Yeah, a little bit. You're going to be down on that position. But if it doesn't, if it goes up at all, you made a 3% return in 3 days, which is pretty wild. So there's definitely a lot of potential here. A trade that I might consider taking is just looking and saying, okay, well, here, if the at the money is great, well, what if I'm slightly out of the money? What if I sell the 22? Well, this is still a 1% return. The stock has to drop $3. The stock has to drop 10%. Again, I'm not saying that it can't. Like, let's look at where that level is. 22 is only here. You know, it could easily drop that much. These moves are massive. But this is where it can be kind of fun to trade these. So let's look at the table again and say, well, what if I was to sell that 22? And what if I was to just buy the 22 further out? Like, what can I pay for this? This is $68. That may not be very worth it at all. But now I've got a trade that has quite a bit of potential. I can make $50 return. I do have some upside risk. So this is where I might play something where I'm selling two. So sell two, and I'll buy one calendar. And now I have very little. And this is where, again, we was talking about complexity. I have max loss of $22.39. My max profit is $80. So I have a max profit of 4% return on capital, and probability of profit is 52%. Now, if the stock goes above $24, I probably am not making any money. You know, so there's definitely some upside risk, but I can play with these. And this is like a rather simplistic trade. This is selling some 22 puts. And again, we can be a little bit even more aggressive with this. Let's just delete this off. Let's go back to that table. What if I sold the 23? What if I sold the 22? And then I go out. That's 10 days out. Sorry, my mistake. Let's trade these. These are on that. We're doing the 3-day, right? Like that's where the optimal, that's where the real juice is. So, and then we go on the 9th and we buy one of these. So we're turning the lower one into a calendar. So we've got a one short 22 put, looking down here at the bottom of the screen. I've got the January 2nd short 22 put, and then I have a January 9th 22 put that's long. I'm paying for this. In this case, I get a credit. When I collect a credit for something, it's likely that I would get a credit. And Moomoo is a little bit, what's the word? Generous with their pricing. They're showing that this is a mid price of 7 cents. I don't know if you'd get a credit for this. You know, you may not. But in this case, I mean, the break even's $21. You can make $85, which is still a 2% return on capital. No upside risk, and the downside risk is virtually the same as that short naked put. So, you know, there's one way to do it. You could buy some out of the money puts too. That would change your break even as well. So with some of these, looking at it, going, well, what do I want to do? So, and this is where I start just playing with things until I have a profit tent that I really like. So here's, you know, how much am I risking? I'm still only risking $2,400. My max profit's now $122. I do have some upside risk if the stock goes way up, and it could. You know, again, looking at this, like $26, this becomes a loser. And $26, if we look at the chart, is not that far away. $26 is here. It was there 2 days ago. So you may not want to play with upside risk on these. In fact, I probably wouldn't want to play with very much upside risk at all. So that is something to consider. And it's pretty interesting to see what you can do. So I might be inclined to, you know, just play around with these a little bit. And the cool thing is we can slide these over. You know, so $110 based on $4,000 risk. There's not enough long in here. So maybe it's like that. Maybe I'm buying the 21s. Maybe I'm buying the 20s. Keep it a little flatter. I'm not paying so much. This is a net credit, 67 cents. Does that make sense? Looking at that fly trade, for example, to use the IV slider as consideration as well as the strike price history, the IV slider is, you know, I think that it's hard to model the IV. This IV just basically shows like, oh, look at this, it expands like crazy. IV goes massive, and the reality is that there's going to be a little bit of IV expansion, but it's never going to be as uniform as this chart is showing. IV expansion is definitely something that needs to be considered from a perspective of how much risk we have on. So in this case, what I look at when I'm looking at this trade, the put that I'm selling, the 22, so I'm selling the 23 and I'm selling the 22 in this case, 4s and the 3s. If I consider this one the cash secured portion, then this portion is my protection, right? The peak is going to be where the short is. Let me just take off the 23. If I just remove that, we're going to have 3 shorts and 3 longs. And when I think about this in general, what I'm thinking about is where the peak is going to be, where I think that stock may drop to. So if I think the stock may drop to $22, then I want the peak there. The next consideration is the width. So in this case, it's $200 width, and there's 3 of them. So this has got a $600 in risk. And we can see that right here, max loss $600. If I want that to be less, I make the spread tighter, and or I buy less of them. So by decreasing it, it increases my risk. Max loss on these 3 is now 1968. And I'm not getting any money. This isn't even profitable at this point. It would need to have an IV expansion. Like this is, you can set up a negative trade. So be careful with these. A calendar is going to be the most amount of money that I can make, but it's also going to have more upside risk. So that's when I have no distance between the 22 and the 22. I would say this is like a typical way to protect against a short put. So if I was selling that 23 and I thought, oh, well, this might go to 21, then I would buy that calendar at 21. And then this portion of the trade, the protective portion, is making money between $19 and $23.28. So it is, and could be a standalone trade. This can work by itself, right? You can just put this on. This does not, you can see what the risk reward is. You're risking $88, but it's a relatively tight range. So typically what I'm doing with these is I'm saying, I want to increase my odds of winning. And to do that, I'm just selling a very short duration position that has a lot of theta decay in it. And in this case, even though that's protective down here at 21, you can still see it's still a loss. Now IV may help it, but you can see it's not helping a ton. And it's theoretical. So I look at absolute loss. In fact, my RORC, when you program these trades into the RORC, they calculate absolute loss. I let Moo and Interactive Brokers chart this for me the way they think it's going to play out. But my record keeping is absolute loss. There's no extrinsic value calculated in there. So when I put in a calendar trade, it actually is just a flat line on the bottom of my RORC, and it's saying my expectation is that the stock is going to trade close to that peak, but the peak doesn't show in my RORC. It's just all risk. So diagonals. I have a better conceptual idea of how much money I'm actually risking when I'm putting on those trades, if that makes sense. And then I think price history, the delta tells us everything. If we were looking at this from a perspective of where the price is going to be based on current pricing, if we look at delta, we know percentage-wise, this column is telling us, there's a 48% chance that, which is basically 50-50, that this is going to be in the money. as we go further down the chain, we have a 37% chance that this one's going to be in the money. So typically as premium sellers, you know, when I learned to trade options, I was looking at these, you know, 14, 15, 16, kind of 18 delta. That was the sweet spot. And the question always was, can I get enough premium for this? And what is enough premium? Like on an annualized basis, if it's a good stock, then am I okay making, you know, this only a 5-cent return, but it's 5 cents in 3 days. You know, if we look at that same strike, if we just clear all of this off, if we look at that 21, well, it's getting 55 cents. Like, this is an extremely lucrative amount of money, and this stock can jump all over the place. So I don't mind taking a little bit more risk on a trade like this. And the reason being is because if it jumps down, like, look how much their premium there is on the call side on a weekly. And, you know, you have to look at the chain, like, is there earnings coming up? Moomoo is really great at that. They put their earnings right in here. So again, you know, another thing that I like about Moomoo, and why I'm kind of using both brokerages at the same time, but I know that if I get assigned, like, say I take this order and I place, let me just build that trade again, exactly how I would play it. Like, if I want to sell maybe this 22.5, which is just slightly out of the money, it's not at the money. Max profit is 50 bucks. This is a 65% probability trade. That's an excellent trade already. Now, if I sell 3 of those and then I go out to a later date, let's just go out to January 9th. You know, even buying 1 of these is going to change that curve. So why did that? So there's 2 and there's 1. 2184. I've got, that's $4,000 in risk. I need at least 2 in here to drop that max loss down to a 1 lot. So 54% probability of profit, no upside risk, theta decay of $22 a day, which is theoretical. If nothing changes, this trade makes $132 if the stock is trading exactly where it is. Now, there is some risk to the upside. So when we're doing that, you know, and this is where you kind of have to play with these a little bit. So slide this down maybe, and let's reduce that down. So now I'm getting a dollar credit. So $196, no upside risk on this trade because it's collecting a credit. Credit being super important when you're doing some sort of ratio. So in this case, you're collecting credit. So that means that when these expire, say the stock goes up, say the stock's at 30 bucks in a couple days. Well, these puts that you own that are still a week out may not have any value left, but it doesn't matter because you collected a credit to start. So if a diagonal starts with a credit, it's excellent. If it doesn't, then it's not so good. You'll see even this is like a great little trade. Getting a $17 debit, max profit 170 bucks. Like, there you go. There's a trade. $17 credit. So there's no upside risk on that trade at all. And what's the worst case scenario? Well, then you're buying or rolling a short put at the 2250 strike. And you can do that with as low as the total risk on this trade, $233, max profit 56. So it could make a 25% return. And this is in 3 days. Killer trade. How would I set this up? I would do it like this. I would add a bit of premium. I mean, I want to make some money, you know, that's the thing. So let me screen grab this. I like both those setups, and I don't mind rolling those. $100 credit to start. Okay, how does that feel to you guys? Look at that, it's 11:59, just like that. I don't know about you guys, but my stomach tells me exactly when it's noon. It's part of the reason why I do these live streams at 11 Pacific Standard Time, which is I'm on the West Coast. So I'm ready for food now. Trader Bob says, you got to where I was thinking. IV collapse impact over earnings. Was just wondering if that slider helps planning calendar trades that span earnings. The issue with earnings in general is that the IV collapse equally affects both sides of the contract. So when you have a calendar in play, when you have different days to expiration, both of them have the IV collapse that occurs. So typically the chart looks amazing. You're looking at it, you're like, I'm gonna make so much money. There's gonna be this IV collapse and it's gonna be great. Reality of trading calendars over earnings, when we see any sort of dramatic IV reduction, they become losing trades. I do not trade calendars and diagonals over earnings. I don't think they're good setups. If I want a peak trade, I play a butterfly over earnings. Butterflies are great for high IV. They function well if they stay in the range, or if you want to move outside of the range. So we've got either play a long butterfly or a short butterfly, depending on what you want. A short butterfly would look for it to move outside, and a long butterfly would keep it inside if you're doing calls or puts. Yeah, that's kind of what I do not play earnings with diagonals. It has never worked out for me. I never once have modeled it in a way that the modeling never matches the outcome, even if you're spot on. Okay, you guys are amazing. Thank you so much. 2026 is going to be fantastic. If you're not on the newsletter, I am actually going to be putting out a little promo for another company, which I've just been introduced to. I've been using their service for just a little while. They're Discord-based trading platform. It is specific to earnings. That email's coming out soon. So if you are not on the email list, go to drawbridgefinance.ca. You can just scroll down to the bottom. It's free to get on, and you can just head over there and get on. Or you can get on by going to patreon.com, and then you get my emails. Just make sure that you have me not blocked, so you're actually receiving my emails. But there's a great little promo coming out for a company that I've been introduced to that is going to be great, and that should be coming out I'll probably send it out tomorrow, I would expect. Don't have a schedule around here. Okay, thanks everybody. Happy New Year. I'll see all my patrons on Thursday, and obviously I'll see you back in the chat room. I'm going to put on a couple more trades. Thanks everybody. Take care. Let's get rich together. Bye now.